We're going to be covering off a topic that a lot of people want to know about, which is specialist mortgages. So these are mortgages for people who may have been declined a mortgage from their bank, or potentially some people that just have some issues. Always remember that your home may be repossessed if you do not keep up your repayments on your mortgage. So we're going to get started. Be sure to put any questions that you have in the chat because we will be answering your questions live. My name is Anthony Lindsay, and I've been in finance for over 30 years. I've done three key things in finance. I've done lending, so that's mortgages, personal loans, I've done wealth management, and I've also done collections. So when I talk about mortgages, I talk about them not just from the perspective of getting you a mortgage, but I also want to make sure that you get the right mortgage, the right information that you can stay in your home. So first and foremost, what is a mortgage broker? I regularly hear people say that they went to their bank and their bank told them that they couldn't get a mortgage. And as I said in the intro, I was in banking and finance for a really long time. And I always thought, well, when you need a mortgage, you just go to your bank and they'll sort out the mortgage for you. Your salary's going into that bank. That bank usually knows you. They've usually offered you a credit card or something of that nature. So you are usually quite happy to go to your bank. In fact, when I was at Lloyd's, one of the things that we always wanted to do was to make sure that people had their salary paid into their Lloyd's account. Why? Because wherever your salary is, you tend to do most of your business. That's where you'll go for your personal loans, that's where you'll go for your credit cards, and that's where you will go for your mortgage. So a broker is an individual that works with several banks, multiple banks, and they're able to provide you with answers to your questions around mortgages. So you get choice when you go to a broker. So think about it this way. You could go from bank to bank and try to find the right deal for you and get no's in some cases and get the best deal that a particular bank could get you. Or you could speak to a broker and they can do all that work for you. So your broker should be your first line of defense. So if you have credit issues, if you're someone that's on a skilled worker visa, if you're someone with a low deposit, a broker will be your first line of defense. Now, quite often we hear people talk about 5% deposits, or we hear people talk about various things when it comes to mortgages. And quite often the information can be misleading unless that person is giving you specific information about you. Because in most cases, what you will find when we're talking about these things that we call rule of thumb or just guidelines, they're talking about the perfect profile. So, what is the perfect profile? The perfect profile is a UK passport, full time employed, PAYE, meaning you get a pay slip, someone potentially on a high salary, someone with a large deposit. But I'm guessing that you're on this call because you don't fit this description. So there is hope. There are specialist lenders. There are lenders that work with people that have various circumstances that mean that they don't meet the perfect client profile. We're going to go through some case studies. So I'll be able to answer your specific questions about the things and the challenges that you may have faced having a non-UK passport, being on a skilled worker visa, maybe have missed some payments in the past. We'll go through all of that. So a specialist lender exists to be able to help you get your mortgage. By going to a mortgage broker, you can access specialist lenders. I'm sure that you're probably asking the question, well, what does it mean if I go to a specialist lender? Well, to be completely transparent, in a lot of cases, it will mean that you will pay a slightly higher interest rate, or it may be that there's higher fees to get that mortgage. But considering the alternative of not being able to get a mortgage, as long as the fees are disclosed in advance and you can afford the fees or you can afford the monthly payments, a specialist lender may be a good option for you. So Specialist lenders are going to deal with different kinds of people. So they're going to deal with people that are expats. So it may be people that have a UK passport but are no longer in the UK. This quite often happens when you have individuals that have migrated or immigrated to the UK. They've lived here, they've settled, they've worked their whole career, and then they decide to go back to their country of origin. So they're considered expats, but they might want to get a mortgage in the UK. This also applies to contract workers. So this would be someone who gets short-term contracts back to back. So this is a little bit different than someone that's on a 0 hours contract or on a short-term contract. These are people that are usually program managers, project managers, things of that nature, people who are contract workers. Another reason why someone might end up with a specialist lender is because they've changed jobs recently or they're on probation. So these are all falling under the complex needs that people will have. And do keep in mind, be sure to put your questions in the chat and we'll be able to answer those questions for you. I do see that we have one already, which is, do brokers charge a fee? And I'll cover that off. But the short answer is some do, some don't. But we'll unpack that a little bit later. So the first type of client that I'm going to look at that might be suitable for a specialist lender is someone named Mark. So Mark has a UK passport. He lives in the Midlands, but he's a contract worker. His income is about 64,000 per year, and he has a deposit of 17,000. Now, someone like this may have been declined a mortgage from their bank because they're a contract worker. And the way that banks are going to view the contract, they may not take the full salary. They may not even lend to people that are on contracts. Even though Mark has a fairly high salary, he has a UK passport, he may end up going to a specialist lender. So I've helped several people like Mark just in the last 6 weeks. I've helped one individual who had just started a new contract after being out of contract for about 4 weeks due to the holidays. So there is hope if you are a contract worker. And whether you're a UK passport or not, there is hope. And this would be one of the scenarios where you might need to go to a specialist lender. Now, I imagine a lot of people listening and a lot of people on the call probably fall into this category. It's non-UK passport. So that could be a range of different things that will include skilled worker visa, someone that's just arrived in the UK, or someone that's been here for a while. So I'm going to go through a case study of a non-UK passport holder, someone who is on a skilled worker visa. So this is Robert and Mercy. They're on a skilled worker visa and a dependent visa. They're in the north of they're in the north of England. They have a good credit profile. We will talk about credit profile shortly. They have a combined income of £52,000 per year. They're looking to purchase a property and they have $12,600 for their deposit. Now, there's a couple of things about this profile. Thing number one is that combined income is made up of two individuals that are working full-time PAYE. PAYE means that they're getting pay slips. One of the individuals is paid every 2 weeks. The other one is paid monthly. So what I'm going to need to see for this client is I'm going to need to see their share code. So they're going to need to have a share code, generate that. It will start with an S. I do have a video showing you how to generate a share code. So that's the thing that we're going to need first and foremost. In this case, they're going to need at least 2 more years left on their visa. So 2 more years left on their visa. Now, because they're in the north of London, the property prices are a little bit less. Now, when I talk about the good credit profile, some people view the credit number, the credit score, as the credit profile. What I mean by credit profile is the way that they have conducted their credit. So in a real sense, I've had clients that have had credit scores of 850 and above, but maybe have missed a payment in the last 6 months. And not that I wasn't able to get them a mortgage, but I did have to go to a specialist mortgage because they had those missed payments. However, I've had other clients who have had credit scores of about 780, 790, but have never missed payments and didn't have to go to a specialist lender. Quite often, with the skilled worker visa, the reason why you end up going to either a specialist lender or not one of the lenders on the high street is because not that many lenders lend based on the skilled worker visa, and the ones that do are not going to do a really low, allow someone to have a really low deposit. I know as of the airing of this video, there are several lenders that will allow a 5% deposit. Now, I try to avoid talking about percentages. So if anyone's ever had a one-to-one with me, the question that I'll ask is, how much do you have in pounds, not as a percentage, how much do you have in pounds for your deposit? The reason why that's really important is because if you're looking at a house and you're saying I have 10% and you were basing a property of 200,000, and then you find a property that's 210,000, that 20,000 that you have, which was the 10% of 200,000, is no longer sufficient. So the way that I work, and a good mortgage broker will look at your individual circumstances, find out how much money you have specifically, and then they'll work backwards. So in this case with Robert and Mercy, I was able to get them a mortgage because they had a good credit profile, meaning they hadn't missed any payments within the last 6 months. They also had a good credit score. They were able to produce the right documents. They'd been in the country for 18 months, which meant they got over a lot of the hurdles. There are specialist lenders that will lend from day one being in the UK, but that's probably going to be to people that have a income of 100,000 or more. So I do find that a lot of the people that I deal with that have skilled worker visas, their salaries are anywhere from 22 to 32,000 per year. So they're not going to qualify necessarily for some of the things that someone on a salary of 100,000 a year would qualify for. The next thing is you may have credit issues. By credit issues, I mean you may have had late payments, missed payments, CCJs, defaults, anything that would give you a less than perfect credit rating. There may also be errors on your credit report. This is why it's so important that at least once per year, you check your credit file. You can check your credit file using Check My File. The reason why you will find that most financial experts suggest that you use Check My File as opposed to the free credit scoring you get through your bank or other services, or even going directly to Equifax or Experian. The reason why we recommend that you use Check My File, and I will have a video on how to do that. The link is in this description. The reason why you want to use Check My File is because Check My File will give you a comprehensive 3-bureau report. Not every lender reports to every credit reporting agency. So you need to get a credit report that's going to show you all 3 agencies. The Check My File credit report will also show you your address history, show if there's any missed payments, late payments, any settlements, CCJs, everything. They'll also show how many searches have been done against your credit file. And this is important because I have found that in probably 7 out of 10 cases, when someone has produced their credit report before sending it to me, they look at it and they say, I didn't know. Sometimes it's an I didn't know in a positive way. For example, it's I didn't know that my credit score and my credit profile was as good as it is. Sometimes they'll say, I didn't know that my credit score was not that good. But quite often people will find things on their credit score or on their credit report that they weren't aware of. And this is usually a result of a person, a couple or a girlfriend or a boyfriend, and they apply for some credit together. And what that will cause is a link on the credit report. So that person's credit will now impact your credit. It also happens when people get divorced and they still have that financial tie on their credit report. This is why it's really important that you check your credit file once a year and you remedy or resolve any issues on your credit report before you try to get a mortgage. I had a client not too long ago, amazing profile, UK passport, hasn't had any issues in several years, but there was something on their credit report. They had paid off a BT bill, so there was a small outstanding amount on a BT bill. It went into default. They paid it off, right? However, BT did not update their credit file, which meant it was still on their credit file and it was not showing as settled. We started the mortgage process and that was there. We reached a point where the lender was like, well, we have to get this resolved. Now, this person had already paid it, but was willing to pay it again just to get the mortgage. But the lender needed to see a verification that that had been resolved. But because that error was so old, BT didn't even have an account for the person anymore. Long story short, it delayed the mortgage and it prevented them from being able to proceed with that lender. Now, if we had been able to resolve that 3, 4, 5, 6 months prior to going forward for the mortgage, then it would have just flown through because everything else was really good. So check your credit file. If you don't understand how to review your credit file or how to access your credit file, make sure you check out the link in the description about how to access your 3-bureau credit report. Now, there's a last profile that we have, which is James and Paula. James and Paula are both UK passport holders. They have some what we call satisfied CCJs. So a satisfied CCJ means essentially that the person had a county court judgment, meaning that they didn't pay a council tax or something along those lines. It wasn't resolved at first, but they later satisfied it, meaning that they paid it. That thing will still stay on the credit report for up to 7 years. So it will still report on there. Lenders will still look at that. But some lenders will say, well, as long as it's less than X amount, 300, 500, whatever, we're okay with it. Some will say, as long as it's satisfied, we're okay with it. But what you want to do is try to resolve those things before you get to that point. But you can get a mortgage if you have CCJs, and you can even get a mortgage if the CCJ is unsettled, but it's ideal that you settle those CCJs. So James and Paula also had some missed payments, but those were 18 months ago. So they had the foresight to say, well, you know what, we're going to tidy up our credit. We're going to make sure that we don't miss any additional payments, and we're going to maintain our credit profile in a strong way before applying for a mortgage. They had a deposit of $15,900, and so they were able to proceed. I was able to get them a mortgage. Keep your questions coming. I have a question that is in the chat. The question is, I've just lost my job and I'd like to apply for a mortgage. Can I apply for a mortgage? Well, the short answer would probably be no, because the lender is going to need to know how you're going to repay your mortgage. How are you going to make your payments without a job? The good news is you can apply for a mortgage in many cases with many lenders, even if you just have a job offer. Now, the job offer will have to be from a nationally recognized business or company. So it can't be your friend's limited company or family member's limited company. It would have to be a nationally recognized organization, let's just say the NHS or a major bank. A lot of lenders will lend to you with an offer as long as you're starting within the next 3 months. So you can have an offer letter, you can apply for a mortgage. Now, on the flip side, some lenders won't lend to a person that is working but is on probation. So one of the questions that I always ask my clients is, are you employed, PAYE, meaning you're getting pay slips, and are you on probation? or have you changed jobs within the last 6 months? Because it doesn't mean that you won't be able to get a mortgage, but it may mean that you end up with a specialist lender. And it's important that you research these things in advance of needing the mortgage. Quite often people do it backwards. People go out and they look for a house, then they go to a mortgage broker and say, "Oh, I found a house for 220,000. I need to get a mortgage." And then when the mortgage broker looks at things, actually they can't afford that house. Or maybe they could have afforded something more expensive. So what you want to do is follow this method and stage number one in getting a mortgage in the UK is to have an initial consultation with a financial advisor, a broker. So as I said, you don't want to go directly to your bank. The best bet is to go to a mortgage broker. What does that initial consultation look like? Well, a broker is going to do something called a fact find. Usually it's an online portal. We work with a portal, so we'll send you a link to the portal where you can upload your documents and you can add the information that we need. The key things that we're going to need is a minimum of 3 years address history, but if you can provide more, it's even better. And you will need to provide address history even if it's outside of the UK. So if you've only been in the UK a year and you need to provide 3 years worth of address history, the additional 2 years that you weren't in the UK, you will need to provide even if it's international. So you're going to need to provide your address history. Similarly, you're going to need to provide your employment history. So you're going to need the same thing, minimum of 3 years, but the more you provide, the better. You're also going to need to provide demographic information such as how many children you have and their ages, if they're under the age of 18. You'll need to provide your residential status. Are you currently renting? Are you currently living with friends or family? You're also going to need to provide information about you and your outgoing. So how much do you spend per month on various things? The positive thing when you're filling out the fact find is things like how much you're paying for rent. Your rent is not going to be taken into account because when you get the mortgage, you're not paying rent anymore. So the things that they're really looking at are things that you will continue to pay after you get the mortgage. So if you have any loans, if you have any credit card balances, anything of that nature, those are the things that you're going to want to include on there. Now, a key piece of advice when completing the fact find for the initial assessment is be as thorough and as accurate as possible. Specialist lenders can deal with pretty much any situation if they know. If you do not disclose the information, then the broker will not know, but it will come to light at some point. And what lenders don't like is something called non-disclosure. I'll give you an example of what non-disclosure is. You may have a client who has opened a Capital One credit card 2.5 years ago, right? They've had that credit card. They used it when they first opened it. For the last 2 years, they haven't used it. So they say, I'm not going to include that, right? Then when the credit report is run, the bank sees that they have that credit card. Now, they may not use the credit card. They may not have a balance on it. So it's not that they've missed payments, but the bank's like, why wouldn't this client or this customer tell me about this credit card? So you want to disclose everything. And if you don't feel that you can be open and honest with your broker, you're working with the wrong person. Okay. You should be able to be very open, very honest, because then that broker can find solutions. In many cases, when they're dealing with specialist lenders have what they call a manual underwriting process. Meaning it's not just that they press a button and it goes through to a computer, the computer sends it through some algorithms and it gives an answer. A manual underwriting process is where a human being will look at that application, which is why the more information and the more context that you give to your broker, they'll be able to explain something that's happened. So I had a client recently where when I looked at his credit profile, everything looked great, but maybe 2 years prior, the credit card had gone 2 months in arrears. Now, looking at everything else, it just didn't make sense. So when I asked him, he said, well, I had a death in the family, I was out of the country, and I was unable to access the payment portal for that particular product. That makes complete sense. I've done underwriting, and if I looked at the credit file, my first instinct would be this doesn't look like this client. But when someone is doing manual underwriting, what you want the broker to be able to do is paint the picture, tell the story, and it should make sense based on how that individual manages their finances. So now you've done the financial assessment. The broker will produce what's called an agreement in principle. Some people call it a decision in principle. This is where I lose a lot of clients. I, as a broker, put all my effort and do all the due diligence before producing an agreement in principle. I had a call from someone this week actually who said that, they went on their bank's portal, they got an agreement in principle. The agreement in principle gave them a guide amount of, let's just say, 230,000. They went out, they found a house at 230,000. Then when they went back to the bank to convert that to a mortgage offer, which is the important part, the bank said no. Keep in mind, an agreement in principle is not a contract. In most cases, it's not a credit check. It's just you putting numbers in a computer that are unverified, the computer then spitting out an answer. So I, as a broker, I don't do it that way. I'll make sure that I verified all the figures. I'll make sure that I've done the math. I'll make sure that I've seen the credit report, because an agreement in principle that cannot convert into a mortgage offer is a waste of time. So as important as an agreement in principle is, because many estate agents will not allow you to view a property or to make an offer on a property until you have an agreement in principle. So it's a very important document, but it's only important and it's only valid if it's accurate. So the way that I process the whole mortgage journey is, before I do the agreement in principle, I'm going to check all the figures. I'm going to make sure I have all the documents, because my success rate in agreement in principle to mortgage offer is in the high 90s. There will at times be some things that I can't see and the borrower is not aware of, but that's very rare. What can happen though, and I've seen this happen, is I'll get an agreement in principle for someone based on everything that they've provided to me. And then in the process of going from agreement in principle to mortgage offer, which is when they do the credit check, it's also when they just run it through all of their criteria, the person took out a loan. So here's a tip. Whilst you're looking for a mortgage and leading up to it, do not apply for any additional credit. Do not take out any other credit. And if you have small balances on your credit cards, pay them off. So you do want to have balances as you build your credit profile. But I'd say 3 to 4 months before you apply for your mortgage, stop using those credit cards. That will allow you to have more affordability. Affordability is very important, because if you make $5,000 a month combined, if it's a couple, and you're bringing in $5,000 a month into your household, when you deduct all the things you have to pay, you may have disposable income of, let's just say, $3,000. Then they're going to look at what you're paying out on loans and other things. When you have credit card balances, etc., that's going to decrease the amount that you have as disposable income, and therefore it's going to limit the amount that the bank will lend you as a monthly mortgage repayment, because banks do not want to get you in trouble. Banks don't want to be in a position where they have to foreclose on you. Banks do not want to be in a position where you're unable to make your payments. Banks want to give you a mortgage, you pay them every month, they make their profit, and at some point you pay them off. That's what banks want. Do not think for a second it's personal. Banks are not there to mess you over and foreclose on your property. As someone who worked in pre-litigation for HSBC, I can tell you, it's not something we love to do. I did not enjoy going out and having to talk to people and say, listen, your home is in foreclosure. What can we do to avoid that? Okay, so a bank is going to want to make sure that you have the affordability not only to get the mortgage, but to keep the mortgage. So once you have the agreement in principle, you can go out and search with confidence, knowing that there's a pre approval for an amount. A question that is in the chat is, how long is an agreement in principle or decision in principle valid for? The answer is it depends on the lender. Some agreement in principles are good for 30 days, some are good for 6 months. But when you receive that agreement in principle or decision in principle, it will say how long it's valid. And usually, as long as your circumstances haven't changed and you haven't gone out and purchased anything or applied for additional credit, if they need to extend it, they will be able to extend it. But the thing to consider is products are changing all the time. The Bank of England meets every 6 weeks and reviews the base rate. And based on the decision that is made when they have that meeting, rates change, products may be removed. An agreement in principle is not a mortgage offer. So once you've got that agreement in principle, you've now found a property, you're going to need to negotiate the price of a property. Here's probably one of the best things that I can tell you. The estate agent works for the seller. The estate agent does not work for you. The estate agent works for the seller. So the estate agent's job, their fiduciary responsibility, is to get that seller the highest price for the property that they can. Hear me when I say this. The estate agent does not work for you. And you do not do this every day. So you don't want to negotiate with the estate agent yourself. I will negotiate for my clients. So I do this every day, right? So I'm going to be better at it than you are. So what you want to do is allow your broker, if they do provide this service, to negotiate the deal for you. Because think about it this way, you're working. You don't want to have to take your break and go and talk about all your personal finances and miss a call. And, you don't want to do that. Your broker is doing this all day. They can negotiate the deal for you. They can get you a better deal. On average, on a UK property in London, I'm able to save someone about £6,000 by doing the negotiation on behalf of my client. But it will involve the client being completely honest with me about what their top price is. And this brings me back to budgets. Quite often, an estate agent, when you approach them in the mortgage process or in the house buying process, they'll say, what is your price range? The mistake that most people make is they will say, all right, let's just say they're looking to buy something at 200,000. They're usually going to tell the estate agent 180 to 200,000. The estate agent completely will ignore the lower figure because the known statistic is people buy at the top of their budget. No one buys at the bottom of their budget. But what the estate agent is going to do realistically, if you say your price range is 180 to 200, they're going to show you properties at 210, 220, 230. All right? That's just how it works because the seller has usually listed their property at a higher price than they're actually looking to get for it. This is why you want to make sure that your broker is negotiating for you. So you've got your agreement in principle. Your broker now goes out and negotiates a great deal for you. At this point, you'll get an acceptance letter from the seller. It's a legal requirement that the seller sends you an acceptance letter. And another note is it's also required that the estate agent, regardless of if they think the seller will take the offer or not, they are required to communicate the offer to the seller. So what you will find if you are in a position where you're negotiating yourself, you may put forward a number. And that number may be lower than the marketed price. And then the estate agent will be like, oh no, the seller's not going to go for that. That's fine, but they have to put that number in front of the seller. Another thing to consider, a price listing is just a marketing price. The value of that house is what people will pay for it. So you can negotiate hard. And I would say don't negotiate with your heart, negotiate using logic. Look at the property. And if the property is ridiculously underpriced, it's probably underpriced for a reason. So you now have negotiated, the offer's been accepted, you've received the offer letter, and you're now ready to convert the agreement in principle into a full mortgage offer. At this point, this is when the credit check is done. So this is when, as a broker, I am going to fill in a full mortgage application. I will provide the documents that the lender has asked for. I will provide the lease terms and the specifics about the property, how many bedrooms it is, who the solicitor is for the seller. And that's another thing to keep in mind. When you're buying a property, you will need a solicitor. Do not go for the cheapest solicitor. Do not select your solicitor based on price. And here's why. Let's just say your mortgage is let's just say your rent is $1,200 per month. And you see a solicitor, one of them is charging, $1,100 and the other one is charging $1,900. You say, "Oh, I'm going to go with $1,100," right? But if that solicitor delays your deal, because remember, every mortgage and purchase process is as fast as the slowest person. If they delay it 1 month, that's an additional £1,200 in rent payments. If they delay a month and a half, that's £2,400 additional to save £700. So what you want to do is find a solicitor who is going to move the deal along quickly, someone who has a good rating on Trustpilot. I usually recommend a solicitor to my clients, keeping in mind, if you go to your cousin, your friend, someone that you know, not every lender works with every solicitor. So you want to find someone who's going to work fast and will work with the lender that you have. I have another question. Will car finance that I already have an impact on my affordability? Yes, because if you have car finance, let's just say you are paying £250 a month for that car finance. That's £250 that you don't have. So if you made, if your income is £3,000 a month, £250 of that is already gone to that car finance. So yes, it will have an impact. You've asked, will it have a big impact? It all depends on proportion. If you're making $5,000 a month and your car payment is £154, then it's not that big a deal. But if you're making $1,500 a month and that car payment's $154, then it's a bigger impact. The next question is, if I decide to leave the UK and I have a mortgage, can I sell the house back to the bank? If it's possible to do that, do I get my full payments back or part of it? Absolutely not. Firstly, the bank technically owns it on paper, but you're paying a mortgage. Now, you can sell the property, but you're not selling it to the bank. You can sell it to another person, just like how you bought it. What you will get, and I think maybe this is part of your question, let's just say you purchased a home for $200,000. You paid down a £10,000 deposit. What you then owe the bank is $190,000. If you've taken out a traditional residential mortgage, that means you're paying back the interest and you're also paying back the principal. So in theory, each month that you make a payment, the amount that you owe the bank goes down. If you've had that house for 10 years, the value might appreciate to 230. So you bought it for 200, you kept it for 2 years, it's now worth 230,000, plus you've been paying down the mortgage. So let's just say you now owe the bank 180,000 because you've been paying the mortgage. The bank is going to only want the 180,000 back, but the property is worth 230,000. So the 50,000 you get to keep. You get to either take that to the other country with you, put it in a bank account. You could also consider converting that residential mortgage into what they call a buy-to-let mortgage, which means you can retain the property. You could reduce the payment because it's a buy-to-let. Instead of having a repayment mortgage, you can have an interest-only mortgage, which will make the payments lower. Then you can rent it out. And the difference between what the mortgage is and the rent that the person is paying you, you get to keep. So the question was, can you sell it back to the bank? No, because the bank doesn't want it. Can you sell it to someone else? Yes. Do you get the money back? No, because it's not rental. You're not renting the property. And even if you were, you wouldn't get that money back. So, really good question. I love that you've asked that question, because what I do find is the questions that you have, probably 10 other people have. So, thank you so much for that question. The next question is, will huge credit card balance impact? Fantastic question. Again, it's all about proportion. But the way that the bank views credit is something called utilization. So if you have £10,000 of available credit, so across one card, three cards, five cards. So let's just say you have £10,000 worth of available credit, and you're using or utilizing £5,000 of that available credit, you're at 50% utilization, because half of 10 is 5. All right. That's okay. But if you're using 9,000 and you're at 90%, that's a little bit more worrying. So, will a huge credit card balance impact? It depends on the total amount of credit that you have. It depends on how you manage that credit. It depends on your income. It depends on so many different things. So, I would suggest not using a lot of the credit that you have available. And as I said earlier, 4 to 5 months before you apply for your mortgage, just stop using it altogether, that you have a really low utilization. And the next one comes from, long story short, what is the process of turning a residential mortgage into a buy-to-let mortgage? Now, Sophia, thank you for asking that. This is not a plan. I'm so glad you asked that, and it's a really good question. So you can convert a residential mortgage into a buy-to-let mortgage. First, let me define a residential mortgage. In most cases, a residential mortgage is a mortgage that has been taken out for an individual or family to live in the property. So that's your home. That's where you live. That's where you come home from work every day. A buy-to-let mortgage, in most cases, is a mortgage that is taken out on a property where the person that's taking out the mortgage is not going to live there. So they're going to let it out or rent it out. So it happens a lot. Someone has a residential mortgage, just like the question that was asked earlier, and maybe they're moving out of the country, or maybe they want to buy a second home. In order to convert a residential mortgage into a buy-to-let mortgage, in most cases, you will need to have about 25% equity in the property. Sometimes you can get away with 15%, but just to be safe, you'd need to have about 25% equity in that property. One of the great things about getting a buy-to-let mortgage, if you're just getting a buy-to-let mortgage, is quite often you don't need even to have an income. Okay, so as a guide, you might not even need to have an income. What a lender is going to look at is, well, the mortgage is $500 a month, because in most cases people are going to get an interest-only mortgage, and you're able to rent it for $1,200 a month. Unless you're a higher rate taxpayer, as of the airing of this video, you just need to be making 35% more than your mortgage payment. So as long as when they assess that area, the rent is at least 35% more than the mortgage payment, it can go through. But one thing to be mindful of in getting a buy-to-let mortgage is, if it's your first property ever, not all lenders will lend to what they call first-time buyers, first-time landlord. That means the person's never had a property in the UK, they're a first-time buyer, and they're looking to buy a buy-to-let property. So the question was, what is the process of turning a residential mortgage into a buy-to-let mortgage? You'd have to either go to the same lender and convert the mortgage, which means you're starting a new mortgage, or you can go to another lender. One thing to be mindful of, if you're in a fixed period, meaning you've entered into a mortgage that has a term, so the term is the long number. The term is the overall 15, 20, 35 years, right? But your fixed rate, if you go with a fixed rate mortgage, the fixed period is the period of time that you have a set payment. quite often people look at it as short, medium, or long. So a short-term fixed rate is usually 2 years, medium is 3 to 5, long is over 5 years. So if you're within that fixed rate period, you'll be assessed what's called an early repayment charge. So an early repayment charge. So if you're converting that residential mortgage into a buy-to-let mortgage, you're ending the deal that you had. And if you do it within the fixed period, you will be assessed an early repayment charge. So you'd need to assess that and do the calculations for that. That's another thing why you'd want to go to a broker, because it may be more beneficial to do the buy to let with your existing lender, but you want to know what is out there. So you'd want to make sure and talk to a broker. So you've now done your full mortgage application. At this point, the bank is going to do what's called a valuation. This is a bit that can be a little bit tricky and hard for people to understand. So you have agreed a price of $230,000 for this property. The bank is now going to go out and do what's called a valuation. They're going to go out and say, what do we think it's worth? We're the ones that are putting up the money. Do we think that it's worth 230? There'll be one of three outcomes. Outcome number one, they'll come back and say, yep, we think it's worth 230 as well. That's great. That's what you want. Outcome number two is they might say that it's worth more than 230. Woo-woo! Great outcome. Outcome number three, this is why the amount of money that you have for the deposit is vital. Because if they come back and they say, well, we think the property's worth $225,000, either you need to come up with an additional $5,000 to bridge that gap between the amount that the bank is willing to lend you and what they valued the property, or you may need to restructure the deal in another way. Maybe the bank can lend you a little bit more, but it's really important that you do the math beforehand and you have a little bit of money left over. So this is the stage where things start to progress. You get the valuation. That valuation can either be done by them doing what they call a drive-by valuation, where they literally drive by, or they can do what's called a desktop valuation. I've had situations, particularly if you're in an area where there's a lot of movement in the houses being sold, they can just go into a system and say, yep, we think that the house is priced this. Also, I want to stress it's a valuation and not a survey. As a home buyer, what you do want to consider is getting what they call a RICS survey. There's different levels. This is when they go in and they check for damp, they check various different things. So you do have to pay for that, and there's different ranges. As a RICS certified surveyor, they all have to do the same thing. So it's going to come down to service. Again, don't just go with your cousin. Go with someone that's reputable. And the other thing about the surveys, not every lender will accept a survey from everybody. So make sure that you take the guidance of your mortgage broker. So you now have the valuation. Once the valuation is done, you'll get the full offer. This is when everything starts to move fast but slow, because this is when it then goes into the hands of the solicitor. And a bit of good news, when it comes to your deposit doesn't come out of your account until pretty much towards the end of the process, which right now is taking 4 to 6 months. So another tip for you guys, put that money in a high interest savings account. You might make a couple of bucks every month, and it can help you towards your moving costs. So the legal and conveyancing is done. Then you move into exchange. Then you move into your new home. And that's what it's all about. Nobody wants a mortgage. People want a home. But you have to get a mortgage in a lot of cases to get a home. So the next question is, for buy to let, if you buy a house as a company and the 6 to 8 directors fund $1,000 monthly for capital, would that be considered if the directors will be backers for funding of capital? It's quite a complex question, so I don't want to just break it down. So there's a lot of things in there. A, not all lenders will accept 6 to 8 directors. B, as far as the funding, it would be determined by several things. As I said, are these high net worth individuals? Are these high rate taxpayers? Are they full-time employed and have a property company? It's quite a complex thing, and that's something that A, you'd want to talk to an accountant about, and B, you'd want to have that conversation with the broker that they can give you the best answer. But that's a really good question. Thank you for that. Which ones are the highest interest savings account? Another great question. So most people know who Martin Lewis is. The reason why I usually refer to Martin Lewis and Money Savings Expert is because he's the person that the BBC goes to when the budget comes out. So go to moneysavingsexpert.com and you can look and they'll show you the different kinds of high interest savings account. They're usually not going to be the high street bank. Okay. So they will be reputable companies that are reputable financial institutions that are insured, and they're not like some guy keeping money under his mattress. But what you will find, the online accounts are going to give you a higher interest rate. And what you want to do is you want to utilize your savings the best way you can and make as much money off it. So I would say go to Martin Lewis Money Savings Expert and you'll find a range. And another tip, and I did not really even know about this until I was doing some banking exams. The other thing to look into is premium bonds. Premium bonds. So a premium bond is an interesting thing in that you can open a premium bond. It's a bond guaranteed by the government. So it's not an individual, it's not a bank, it's not a financial institution. It's the UK government. You can get a premium bond with as little as £25. Now, the thing to consider, premium bonds do not generate interest. So this is a different conversation from the high interest savings account. However, a premium bond, each month there's a lottery. And so I know with some people, gambling is controversial. It's not that. This is not the UK lottery. So they do a prize draw once a month from people who have a premium bond. So I opened a premium bond, and maybe 2 or 3 years later, and I'm not saying this will happen with everyone, I'm just giving a real world example. 2 or 3 years later, I won one of the prize draws. Before everybody goes crazy, no, I did not get £1 million, but I got £100. I won a £100 prize draw for a £25 deposit in about 3 years. So I wouldn't have made £100 of interest on a savings account. So that was a pretty good thing. So you can just give it a try. Just open a £25 premium bond. And if you are eligible, make sure you check the eligibility and do your due diligence. Although I'm a licensed broker, I'm not giving specific financial advice because I don't know your circumstances. But do look into that. Go to Money Savings Expert. We're going to be wrapping up. So if you have any questions, please put them in the chat. So as I said, current timelines for purchasing a house in the UK are about 6 months. I would say please try to avoid shared ownership. It does exist, and it's perfect and amazing and wonderful for some people. I would advise that if you are considering a shared ownership property, do 2 Google searches. Google search number 1 would be shared ownership nightmares, that you can hear all of the downsides, all of the risks, all of the problems, and then shared ownership, the best thing ever, and you can see the good things. Make an informed choice. Understand that if you do have a skilled worker visa, it may be difficult to find a mortgage that you'll be able to get on a shared ownership property. The other thing to consider, avoid these properties that are hugely underpriced, because they're usually underpriced for a reason. Maybe the lease term on them is too low. Maybe they're what they consider unmortgageable. It may have something in there. And if you even get it, and it's a difficult one to get a mortgage on, it's going to be hard to sell. So we've had a couple of questions in here about selling and what do you do when you're selling. So then that means, if you've got it and it was difficult for you to get it, it's going to be difficult for someone else. Another question, I'm on a skilled worker visa. I was intending to apply for a mortgage in June, and my visa is expiring in 2027. Are there chances I will be accepted since they'll be having less than 2 years? The short answer is yes. Just give me a call. My information and my booking details will be in there. But the short answer is yes. I do know several lenders that right now will lend on skilled worker visas with less than 2 years left on the visa, as long as the other bits and pieces are in place. Can you offset mortgage with a specialist lender? Potentially. So potentially, it's not a yes or no. Most things with these things aren't yes or no. It depends on you, your personal circumstances, and what other criteria you may need to meet. After missing a payment, what is the right time to apply for a mortgage? That's another big question. It depends. What kind of payment did you miss? How many others have you missed? Um, there's a lot. So you could technically, if your profile is amazing, you could apply right away. Because if it's not indicative of how you usually manage your finance and the story makes sense. So again, I had a death in the family. I was out of the country. I was unable to make the payment. It was resolved the next month. Then it might not be an issue. But you need to be open about it. You need to explain it. It may mean that you can go to one of the top tier lenders. It may mean that it has to go to manual underwriting. But I wouldn't be super concerned if you just missed one payment and it's not how you usually manage your finances. Two more questions. What are second charge mortgages? So a second charge mortgage is essentially when you buy a property and you take out a mortgage, the lender, let's just say HSBC, they have what's called first charge. So that means anytime any equity is being released out of the property or if it's being sold, they need to be paid back first. A second charge might be what's called a side loan or fundraising. So you have equity in your property. And let's just say you owe 150,000, the property's worth 200,000, so you have 50,000 pounds worth of equity and you want to release some of that equity. You can get what's called a second charge either through, well, it would be through another lender. So you can borrow against that 50,000 with another lender. They'll put what's called a second charge on that property. That can be problematic because the first lender has to agree to that second charge. In some cases, it's easier to just do a remortgage. That is a specific question, but a second charge mortgage is someone who sits behind the primary lender. The primary lender has given permission for that additional charge to be put on the property. So that means anytime that property is being sold, the first charge gets paid first, the second charge gets paid second. And we have time for one more question after me. So it seems like we have covered everything off. Remember, things do go wrong. And so you want to make sure that you're managing your budget well, track your spending closely, and leading up to the getting a mortgage, don't miss payments. Don't apply for any additional credit. And one thing that I'm super passionate about is making sure that when you take out the mortgage, remember, you're no longer renting. So if something goes wrong in that home, you're responsible for it. Make sure that you get the adequate insurances. I've heard it said, and I used to teach my team all the time, when people are shopping for insurance, they think about price. When they need to claim on their insurance, they think about service. So not only life insurance, but building insurance. Building insurance is required when you are purchasing a home. You have to have building insurance. You don't have to have content insurance. But as far as life cover, get some life cover. Make sure you get a will. Make sure when your broker is having the conversation that they are required by law to have with you around income protection, critical illness, life cover, make sure you listen to them. Because remember, they've gone through all of your finances. They'll understand what you have in place, where the gaps are. They're required to give you a quote explaining how to cover those gaps. As someone who's worked in collections, I know that there's only a few key reasons why someone falls behind in their mortgage. Usually it's because of death of one of the partners, it's because of sickness, or it's because of losing their job. Now, no one can prevent you from dying. No one can necessarily prevent you from losing your job, but you can put the right things in place that if it does happen, it won't impact you being able to pay your mortgage. So have a serious conversation. When you're putting those things in place, make sure that you've done your due diligence. If you don't understand something, keep asking the mortgage broker to explain it until you do, because these insurances are hugely important and they're there to protect you and your family. All right. We're all going to die at some point. The reality is we are all going to die. And if you die whilst you have a mortgage, the bank isn't going to just say, oh, well, this person died. Oh, let's forget about that. They still need to be paid. If you have a joint mortgage, you are solely and severally responsible for those monthly payments. So that means each person is individually responsible for those payments, and those two people on the mortgage, or three or four people on the mortgage, are also responsible. So if you've been turned down by your bank, don't think no means never. It could just mean that you need to speak to a mortgage broker. I would suggest you go to a mortgage broker first. So the next steps after you get off this call are to speak to a mortgage broker and get an agreement in principle before you start looking. Start your house hunting, and don't forget to tell a friend. We will be launching something on February 27th called the Mortgage Ready Challenge. So what we will be doing is we'll be working with 12 people each month to get them ready for a mortgage by this summer, that they can be in their new home by Christmas. So that's the Mortgage Ready Challenge. I appreciate everybody that has listened this evening. I thank you for listening in, and I hope you have a great evening. Don't forget to like, share, and subscribe. We're trying to get our subscribers up to 1,000 by the month of March, and we appreciate everyone that's listening. And reach out to me. My details will be in the description. I'm here to help you. If you don't have a broker and you'd like to speak to someone, I'd love to talk to you. My name is Anthony Lindsay. My phone number will be in the description. And I've been in finance for over 30 years. I've done everything from wealth management to collection, so I know a thing or two. Is valued at 100,000, right? Mm-hmm. If you were to pay down 5,000, right, that would be a 5% deposit. Right? Yep. That means the bank is only financing 95% of the loan. So the loan to valuation is the difference between how much the bank is giving you, the mortgage amount, and the value of the home. Now, keep in mind, banks are banks. They're not people that are looking at you as a person. They're looking at risk. Now, understanding that as far as history is concerned, the trajectory for houses is they increase in value. They do increase in value over the long term. They may go up and down, but if you look at a long-term trajectory, the house prices go up. So a bank is going to look at risk. So they're going to say, well, if you've paid down 5%, so you now owe us £95,000, and the house prices go down and something goes wrong and we need to sell that property, we have a greater risk that we won't recoup our money. Right? Oh. That's why they reserve those lower percentage down. In a lot of cases, they reserve it for more stable clients, good credit, established in the UK, etc. Whereas if you're going to pay down a 25% deposit on a property, so you've now paid down, instead of 5,000, paid down 25,000, there's less